G'day guys and welcome to this business management lesson. In today's lesson we're looking at key knowledge point 127. That is unit 1, area of study 2 and the 7th key knowledge point for this area of study. Today specifically we're looking at sources of finance available to different businesses and the factors that you'll have to consider when choosing if a source of finance is right for your business. We know that business costs money, and starting a business especially can cost money. You'll need money for buying the building or renting the space that you're going to be using. You'll need money for buying vehicles, for buying machinery, for buying tools, and certainly for buying the resources that you're going to need to start your business or to run your business in that first place. And then, in an ongoing basis, you'll need to maintain that machinery, you'll need to keep paying rent, you'll need to keep the lights on, you'll need to pay bills, you'll need to pay your employees. Running a business costs money. And it might be possible that you have a business idea, you've seen a business opportunity, a gap in the market, you've developed your business concept, you've got your business plan, you're ready to start a business, but you don't have the money to do it. Well, that's what this key knowledge point is addressing. Sources of finance, where you can get money from. There are two categories of sources of finance that you need to consider. Debt finance, which is where you borrow money with the intent to pay it back, and equity finance, where you're not necessarily paying back the money, but you often have to give up something else in return for the money. Let's look at both of these categories. Starting with debt finance, the most common source of debt finance that you're probably familiar with is financial institutions such as banks. These are well-regulated, well-resourced institutions with a good reputation. These institutions, like banks, can provide short and long-term loan solutions. They can provide small loans. They can provide very large loans. There's often a number of criteria that you have to meet to be an eligible lender from a financial institution. Certainly, if they're going to lend you money, they want to know you're capable of paying it back. So they might want to see your past pay slips. If you're already running your own business, they might want to see your financial records and your accounting. And definitely the conditions of borrowing money from a financial institution are typically that you'll end up paying back more money than you borrowed. Let's say you borrow $1 million from a bank today. You might have caught in the news recently, there's been a lot of reporting about the interest rate and what that's doing in Australia. Well, that interest rate is a measure of how much your debt will increase by per year. And so you might borrow $1 million, and if it takes you 10, 20, 30 years to pay that back, each year an amount equal to whatever the interest is on your account will be added to your total debt. So if the interest rate was 5%, then 5% of your total debt remaining would be added to the total debt each year that passes that it takes you to pay off that loan. So in the long term, you're going to end up paying back quite a bit more money than you borrowed in the first place. Certainly, there are also other considerations when it comes to borrowing from banks. They often have their own fees that also get added to the debt. But generally speaking, these institutions are reputable, they're reliable, and the service is going to be pretty good. You might also be able to borrow from retailers. Not necessarily financial institutions, but well-resourced retailers. And you can see on your screen that Amazon is an example of this quite commonly. Really big retailers might offer their own line of credit or of debt finance. Generally speaking, however, if you're going to pursue this line, you've got to be prepared that you'll be paying a higher interest than you might be with a financial institution. So typically this is best suited to businesses with the finances or with arrangements in place so they know they'll be able to pay off the debt quite quickly so that higher interest doesn't impact on the business. But certainly if you are ineligible to borrow from a bank for whatever reason, a retailer might be able to offer you a line of debt finance that you can take advantage of. Certainly your suppliers that sell you your resources, your inputs, might be able to offer a line of trade credit, which might mean that they let you order from them and they deliver the resources, and then they don't expect you to pay that off straight away. They might give you extra time to get your finances in order, maybe to make revenue off selling the products or the services that you generate using the resources they've given you before you pay them back. Of course, conditions will exist here too. Perhaps this isn't an option available to everyone. Maybe this isn't an option available to you regularly. Maybe you can only do this once per quarter, once per financial year, once per calendar year, something like that. And certainly, if there's a condition like you can't place another order till you've paid off the last one, well, that might leave your hands tied. If you've taken a delivery of resources and you've turned them into products and you're waiting to sell them, while you're waiting to sell them, you might like to generate more product so you've got it ready to go once the first batch is sold. But if you can't order again from your suppliers until you've paid off that initial order, that could be a complicating factor. Certainly, finance companies exist as well. Typically less reputable than financial institutions, and typically targeting individuals for whom financial institutions are saying no to lending money. So if you're ineligible to borrow finances from a bank, something like Motor Finance Wizard or Capital Finance might still be prepared to offer you a loan. Typically, this is a much riskier endeavor because they tend to have much higher interest rates or much higher fees, often hidden fees for consumers who don't necessarily read the fine print before they sign a document. And it can be a risky endeavor unless you are absolutely sure of what you're signing up for and you know that for sure you're going to be able to pay it back. And certainly, if all else fails, you could borrow money from your friends or family. If, as an entrepreneur just starting out, all you need is $5,000 and your friends or family can afford to give you that money, maybe that's not such a bad idea. You'll attract less fees because it's unlikely that your grandma is going to say, oh, time's come to pay up and you owe me 15% interest. So that might be a good idea. But certainly if your business is looking at needing $1 million or more to get started up for capital funds, your friends and family are probably not the right source for that finance. Certainly, one of the considerations when borrowing money from friends and family is that business relationships and interactions around money can ruin relationships. So unless everyone involved in this deal, whether that's directly or indirectly, is completely transparent about the arrangement and totally filled in on what's going on and the conditions for borrowing this money, when it will be paid back, and all of the people involved are operating in good faith, there's a chance that it can create drama. And if your business is creating drama in the lives of your friends and family, you're probably going to do damage to those relationships. So that's something worth considering if that's necessarily something you want to risk. Now, if you're not borrowing money that you have to pay back, if you're not pursuing lines of debt finance, you might pursue equity finance. One of the key distinctions is you pay back the money that you've borrowed with debt finance, but with equity finance, you're attracting investment or money in promise of something else in return, not paying back the money. The first example is private investors. You might have someone who you know has a lot of money and is interested in potentially starting a business or investing in a business. So you might go to them with your business plan and tell them about your idea and offer them the opportunity to invest in the business and become a partner in the business. Or maybe if it's a company that you're starting, to invest and become a shareholder of the business. Typically, private investment like this would be attractive to someone who is interested in having a stake in the business and being invested not just financially in the business, but also in their capability to assist the business through guidance or through relationships with suppliers or through advice. Certainly, the whole concept behind the TV program Shark Tank, if you've ever seen that, is entrepreneurs pitching their ideas at private investors and then hoping that those private investors will not just contribute funds, but contribute business knowledge and relationships and insights about the market to help these businesses be successful. What you're giving up in this example of equity finance is a stake in the ownership of your business. And so the capital, the investment that's paid will go into the business and you'll be able to use that to get the business started, but you are no longer controlling as much of the business as you were previously because you've let someone else buy a stake in the business. Now, venture capitalists are also a type of investor. But venture capitalists typically make their money by buying low-priced shares in a business and selling those shares off when those shares are worth more. They trade stocks in a business as a way of generating revenue. Usually venture capitalists are pretty ruthless, and if your business isn't doing well, they will pull their funding before it costs them too much money, and typically they'll only invest in businesses that look like a good deal to the venture capitalist. Venture capitalists are very rarely invested in a business then they want to have a stake in managing. They don't typically invest in a business with the intention of helping that business build relationships or advising the managers of that business about market forces. They're just looking for a quick way to make money by buying and selling shares in different companies. So if venture capitalists invest in your business, it might be a good influx of cash, but it's not going to come with the same sort of assistance or meddling that private investors might seek to involve themselves in. And certainly, you could look to crowdfund. Platforms like Kickstarter or Indiegogo have been growing in popularity over the last decade, or perhaps even longer at this point. And for a fledgling business or for an entrepreneur with an idea, this might be a good way to attract funds. Certainly, you're not attracting investment, so you're not giving up control of your business, and you'll know pretty quickly if your Kickstarter campaign goes largely unnoticed, it's probably that your business idea isn't attracting attention. If you put your idea out on Kickstarter and you raise $100,000 or $500,000 or even more because lots of people are prepared to give you a bit of money because they think that your idea is great and they believe in your idea, and all you had to agree to do was to send them one of your products when your business actually gets started, then you've demonstrated that there's a demand in the market for your product, and you've been able to raise your funds that way. One of the challenges you have to consider when raising funds through crowdfunding is that typically the funds that you've raised in that initial phase will be spent largely producing that first round of product to send to your crowdfunders, your social media investors, and then it's quite possible that if costs blow out in that process, if timelines get exaggerated, if finding reliable suppliers becomes a problem, it might be that there's not much funds left once that process is complete to continue running your business. So unless you then have another idea that you intend to take to crowdfunding and to the Kickstarter sort of economy, you might be a little bit stuck. So it does take a very careful decision-making process and very, very intricate planning to ensure that those funds are used wisely. In summary for this key knowledge point, every business needs money. They need money to get started and they need money to keep running. And there are all sorts of different sources for business finance. This lesson has not included an exhaustive list of all of the different places that you can source finance from. And you might be aware of an option that we haven't talked about in this lesson, and that's fine. You can absolutely introduce that in assessment tasks. Your teachers have to be prepared to accept that. Just be sure that you're talking about the conditions associated with borrowing or receiving funds from that source, and make sure you're evaluating whether or not that's an appropriate source of finance for any given business context. Remember, there are two categories of finance that we've talked about: debt finance and equity finance. And be very clear for your own purposes that debt finance and equity finance are not themselves sources of business finance. Those are just categories of sources of business finance. But when you're reading a case study, you might pick up on the idea that the business owners aren't looking to borrow money. They don't want to have to pay it back, in which case you can be thinking they'll want one of the equity finance options. Or perhaps the business owners aren't looking to share the business with anyone else, and then you'll be thinking they don't want to sell equity. Perhaps they'll be looking for a debt finance arrangement. And then you can use that thinking to structure your responses in a more appropriate way. Ultimately, when considering if a source of finance is right for your business, you need to be aware of the terms and conditions involved in borrowing from that source of finance, and make sure that you come to a decision based on what you can live with, what what terms and conditions there are, and whether or not those are satisfactory, whether those will be a barrier to the achievement of your business objectives, or whether that's something you can live with. That's all for today. See you next time.